Hello friends, welcome to the channel Way to Treasure. In this video, let's understand what are the metrics that are to be look out for in mutual funds. I don't want to waste your time by explaining what a mutual fund is because there are plenty of content that is in YouTube to know what a mutual fund is. But there are very less number of videos on what are the metrics that are to be look out for when you are choosing a mutual fund. So let's dive into the topic without any delay. Understand what are the metrics that are to be look out for in mutual funds. The first is the amount of risk involved. So if you want to calculate a risk of any investment type, so there are uh, something like called like guaranteed income and non-guaranteed income. If you see that, so if you see any financial institutions, or maybe if you take a bank, if you are lending some money, okay, they'll fix the amount of interest that they are going to charge. Or if you deposit it in any bank, they're gonna say you like this much of percentage of interest that are going to be paid to you on a quarterly basis. So that is a fixed income, and the risk involved will be very low in that. But what is a high risk investment? Like, let's say like you have invested somewhere in Feb of 2020, just before the corona, into some stock called maybe Infosys, and it's almost went down by 30-40% in the next month itself. So there the risk involved is very much high, right? Like if you would have hold, maybe like you would have got 3 times profit, but if you would have sold in just 1 or 2 months, then you would have got somewhere around 30-40% of loss. So 1 lakh could have become just 50,000. So the risk involved in the equity investments are high. So you have to understand in any mutual fund whether what is the risk that is involved in this. And the next is the expense ratio. I have a small illustration in the later part of this video, so please watch that. Like, it has, the expense ratio is nothing but a percentage of amount that is charged from any investor for maintaining their fund. Exit load is after 10 or 15 years, like you want to exit from this particular mutual fund, they will charge a percentage of amount from the corpus that has been created because of this mutual fund. And diversification is means that, like, so rather than keeping everything into one type of investment idea, you have to diversify your investment ideas. Like, if you have somewhere around 1 lakh, invest 50% into equity, 20% into gold, and 15% into debt funds, and another 20% into liquid funds. So this is called diversification. So because of this diversification, what happens, even though there is a loss in equity, you'll get a constant profit from debt funds and liquid bees and the other investment type. Next is historic CAGR. So this is the, you can keep this as a last metric, because there is no guarantee in any investment idea to prove that, like, whatever it has been, I mean, whatever the percentage that has been provided in the previous years can be guaranteed to future. So there is no guarantee that has been given because of this, but you can see like how this has been outperformed, or how this mutual fund has been performed by seeing the historic CAGR. Now let's understand about expense ratio. So this is a percentage of amount that is charged by any AMC who are maintaining your mutual fund. So in every type of mutual fund, there are two types. One, you can buy them directly, and you can buy a regular mutual fund. So basically, what is direct? Direct is something like you're if you are investor and you are buying the mutual fund directly without anyone's help, and regular is you are taking a help of mediator, so that mediator will take some percentage from the AMC directly. So let's see an illustration of if you are doing an SIP of 5,000 per month and for next 20 years, how this direct and regular corpus will be created. So what is your SIP? It's 5,000 per month in both the cases, and both the cases, like your time period is 20 years and you are generating an interest of 12%. And if you see this expense ratio for direct, the expense ratio is somewhat less, that is like 1.29%, and for regular it is 2.23%. The difference amount will, the difference amount will be going to mediator and AMC, like depending upon their terms and policies. And if you see the corpus that is created, if you take a direct mutual fund, you would have saved around 47.2 lakhs. And if you go for a regular mutual fund, you save, the corpus that is created is somewhere close to 40.4 lakh. So what is the difference? There is a difference of around 6.8 lakh for 20 years. That is, that on an average that comes to 34,000 for 1 year. So to save this amount, the only change that you have to make is to create an SIP in, maybe I use Zerodha, but you can use any other broking company which are providing direct mutual funds. Initial target for everyone to move in the direction of mutual funds is to save under 80C. There is a scheme called ELSS, Equity Linked Saving Scheme, under which we can save up to 1.5 lakh rupees from the tax under 80C. But this comes with a lock-in period. And if you want to find those stocks, you can check for tax saver funds. So you can find a plenty of tax saver funds. Like let's open Nippon India Tax Saver Fund. So these, as I said, like these come with a lock-in period. And if you see the CAGR for 5 years, it is somewhere around 7.33, and for 3 years, it is somewhere around 13.39, which is, it's good, because like on top of this, like you will be saving somewhere around, if you are into 30% slab, and if you are investing somewhere around 1.5 lakh, you can save somewhere close to 45,000 per year. So 45,000 plus 13% CAGR is a very good amount. It comes to a very good CAGR. So once you are full with 80C, then you have to look for a good return mutual funds, because like anyway, even after crossing 1.5 lakh, anyway, like you are not gonna get any tax exemption if you invest into mutual funds. So for them, if your age is between 20 to 35, you can still take much risk, from moderate to high risk. So these are these mutual funds are which like we are following, so you can do your own research. If you see the first two, you can choose either of them. First one is Nifty 50 plan, where the HDFC AMC will invest into stocks which are with the percentage, with the same percentage of Nifty 50. So basically, this mutual fund is a resemblance of Nifty 50. And Axis Blue Chip Fund is basically it invests your amount into only blue chip companies. So you can choose either of two, because like both will be have high standards. So you can choose either of these two. And mid cap fund. So mid cap are the companies where like these companies are about to grow. So there will be, in as India is in now India is becoming a good place, a better place for this business and all. There are so many companies which are trying to move from mid cap to large cap. So the growth will be more here. And then when you come to the small cap, Nippon India Small Cap Fund is a, compared to other small cap fund companies, Nippon India Small Cap looks good in percentage of 5 years CAGR, or on yearly returns, or the changes that they do in these companies or in the mutual fund are good. And on an experimental basis, we are investing into UTI Nifty 200 Momentum 30 Index Fund. So what this fund is, they have a strategy which UTI company is following. So they track only top 200 companies, and in the top 200 companies, every quarter they will run a strategy and choose top 300 top 30 running top 30 companies, and they invest their money into only those 30 companies. So that this is generally a momentum kind of thing. Like if anyone knows about what momentum is, like they can understand easily. Like if you don't know about momentum, just let me know in the comment section so that I can prepare a separate video on this. We are into small case now. This company has been backed by Zerodha. So this is basically a kind of briefcase kind of thing where you can you can implement your own idea and prepare your small case. And whenever you click invest now, rather than going into your brokerage and executing each and every trade, this small case will help you to execute all the trades at once, and you can see the percentage of returns on a whole. So we have created a thing called market crash mutual fund. So this is have all types of mutual funds. So we have kept it prepared so that like whenever a market crash happens in the index, so if the index is down by 20 to 30, 35%, then we'll directly come into the small case. And we have a investment idea of maintaining mutual funds till a crash happens. So whenever see, in 2020 a crash happened, so from after that we are investing some amount into mutual funds. Sorry, we are investing some amount into FDs, fixed deposits. So whenever a next market crash comes, we'll have some amount of money to buy that dip. So we whenever the market crash comes, we'll remove that money out of FD and we invest into this market crash mutual fund. To get this link for this small case, like we are providing in the description below, you can check out that, so that whenever market crash comes, and we'll have the money and we'll invest at a very low price or a very better price. So whenever the market recovers, there are high chances of we getting so much, better profits when we follow this idea. I hope you have liked this video. If you like this video, click the like button below. And if you feel that this content is useful to your friends and family, please share it. And if you are new to this channel, please subscribe to the channel by clicking the subscribe button below. And don't forget to click the bell icon so that you will get all the notifications whenever we update on this channel. Thank you for watching. Team Video Treasure signing off.